I put a chart in the Daily Dirt app the other day, which was kind of like an overlay between today's market and the dot-com bubble. And it sort of implied that we are really in 1997 or 1998 rather than 2000. And I'm uncomfortable being in the same trade as 200 million other people because the exit is very small.
Mega cap tech companies have been on a roll lately, especially Nvidia, cutting deals with Uber to power robo-taxis and Nokia to power 6G communication. But are these circular deals akin to what we saw in the late 1990s before the dot-com bubble burst? Jared Dillian of Jared Dillian Money gives us his take today on Global Macro Update. Hey, Jared, good to see you, my friend. Always a pleasure. Thanks for joining us.
Yeah, good to see you.
Some interesting things happening this week in tech, in the tech space. We now have three companies that have $4 trillion market caps, each $4 trillion. Apple, Microsoft, Nvidia. And one of the cool things, or actually not cool things, one of the concerning things that I'm seeing is sort of the rise of what I call circular deals. And you and I are both old enough and have enough gray hair to remember what it was in the late 90s, where you had Cisco doing all these deals with their customers for cash so that the customers wouldn't have to come up with cash and Cisco would get equity. That seems to be bubbling up. Any concerns about that?
I have a bunch of concerns, but I put a chart in the Daily Dirt app the other day, which was kind of like an overlay between today's market and the dot-com bubble. And it sort of implied that we are really in 1997 or 1998 rather than 2000. And, being a trader, like the price action seems to suggest that. As I sit and watch S&P and NASDAQ futures every day, there's really not a lot of volatility. It's a slow grind higher. It's what we saw today. It's what we saw yesterday. We gapped up yesterday on the China tariff news, and then we just crawled higher the rest of the day. There's no volatility. And that's really the type of price action we saw in 1997. In 1999 and 2000, it was insanely volatile, right? The VIX in 1999 was trading between a range of 20 and 30. And this was the biggest bull market in history. And, the conventional wisdom is that when the market rallies, volatility gets suppressed, but it actually expanded in 1999 and 2000. So, we haven't seen that yet. The VIX is 16, and it's going down. So, I don't really have any fundamental advice to offer from like a business standpoint about Nvidia or Microsoft or Apple. But just from a market standpoint, I usually carry around some kind of hedge in S&P puts or some other kind of puts. I usually come up with some structure where I'm not bleeding a lot of carry, and I carry this hedge around just in case of, sort of like tail risk. And it's getting to the point where it's getting expensive to do that, I'm kind of blabbing on here, but I really have a tough time just being long for a bunch of reasons.
You have a tough time being long, but I'm almost wondering if we are in the late 90s or if this time really is different, right? Like we should unpack that a little bit because you've got Nvidia seems to be everywhere. They just made $1 billion investment in Nokia, with the idea being that their technology is going to power 6G. Uber announced that Nvidia is going to power 100,000 robo-taxis, driverless robo-taxis beginning in 2027. And I'm just, that's just what happened in one day this week. It seems like every week there's another big announcement about Nvidia taking a position in another company that happens to be one of their customers. Is this a new type of economy?
It's never different. It's never different. By the way, Do you know who had taxis in 1999?
Yellow?
Yahoo.
Oh, I forgot about
Yahoo
that.
had taxis.
They did.
Yeah. So what they did was is they had these purple taxis,
Yeah.
and you could surf the internet off this screen in the taxi, right? It's literally the exact same thing. I mean, it's different, but it's the same. It's never different. It's the nature of capitalism. You have periods of boom and you have periods of bust. You have periods of overinvestment and malinvestment, and you have periods of bust. It always happens, and it's going to happen this time. So it's not a question of if, it's a question of when. You know, the data center thing is incredible. I brought up the term raccoons in the Daily Dirt app, which was coined by Ben Hunt, you know, and I think Ben Hunt came up with the term, but a raccoon is basically like a money seeking person, maybe a little bit ethically challenged. And you're starting to see raccoons in the data center space, right? Like it's so easy, anybody can do it. So this is like the thing that concerns me is we are in we haven't had a bear market outside the pandemic in 17 years. I guess in 2010 we had a 20% pullback, but it didn't lead to a recession. But we really have not had a sustained drawdown in 17 years. And the thing that worries me is that when we do get the drawdown, is the magnitude of that drawdown going to be proportional to the length of the bull market, right? And it's funny because Andrew Ross Sorkin just came out with 1929, and God bless that guy because he has gotten more publicity for that book than any book in history. He rang the bell at the New York Stock Exchange. They had a big banner behind him. It said 1929 with his book and the subtitle. Like he has been on Bill Maher. He's been on every show in the universe. Like I would die for that kind of publicity, right? But I think it's funny. I mean, it took him 10 years to write the book, and I haven't read it, but knowing him, it's a very well researched book. But I think the timing is kind of interesting. The fact that we have had this enormous bull market that's lasted 17 years. I don't know.
So let me give me one statistic to just, again, sort of press on the is this time different thing. First half of this year, Microsoft generated $145.6 billion in revenue, $53.1 billion in net income, right? So 33% plus margins. The large cap tech companies are generating boatloads of money, just phenomenal amounts of cash flow. Whereas in 1999, we had all kinds of companies that made no money.
Yeah, that's a difference. But you say 53 billion of net income times 4 quarters is 200 billion of net income versus a $4 trillion market cap. Like that to me sounds like a 40 PE.
53 billion was 2 quarters. So 110 billion.
Yeah.
There's no doubt about it. They sure seem expensive. How do you take a company that does $300 billion a year and keep growing double digits?
I don't have the answer to that.
Yeah. I wonder if Satya does. I'm guessing you're not participating in this giant tech rally.
No, and it's funny because I never have. Even when I should have been, like 2013 would have been a good time to participate in the tech rally. 2014, 2016, 2017, those all would have been good times to jump on board. I never have, and yet my returns have come pretty close to or beaten the S&P 500. So you say, well, how do you do that? And there's a lot of I guess what I'm trying to say is the investing world is very large. There's so many things you can invest in. Equities in other countries, bonds in other countries, small cap stocks, commodities, gold, Like, you don't have to do the thing that everybody else is doing, you know? And I'm uncomfortable being in the same trade as 200 million other people, you know, because the exit is very small.
So let's talk about gold, because you've been long gold for a long time. It had a fantastic run up. It grabbed all kinds of headlines when it started to correct recently, and I thought it was kind of funny, you know, like the amount of drawdown that it's had relative to how much it's gone up in the past year it's insignificant.
It's had a 10% drawdown. As of today, it was down 10%, which is, you know, a plain vanilla correction. And I think it has a little bit more downside, maybe another 100, 150 bucks. What I'm surprised about is how fast it happened. It's happened over a period of 2 weeks. I would have figured it would have taken about 3 months to come down to this level. But eventually what I think is going to happen is, you know, gold went up and it's correcting and it's going to bounce and it's going to form a wedge and then it's going to go higher. Which is what it did around 3,500, which is what it did around 2,500, which is what it did around 2,000. You had these long periods of consolidation, and then it breaks out. So still haven't sold any gold or miners. Still long all of it. I'm not really smart enough to hedge it. I've been advised to hedge it by many people. Oh, you should buy some GLD puts. Well, it sounds simple, but if I had bought GLD puts, I would have bought them when gold was at 3,800, not when it was at 4,360, you know? So that would have been a complete waste. So I just leave it unhedged. Just let it do its thing.
Because you've always said gold should be a double-digit part of pretty much anyone's core portfolio.
Yeah, and you have that book in your email inbox.
Yes, pre-print. I'm excited to read it.
Yep.
The Awesome Portfolio. There's one other thing I wanted to chat with you about, and that is just how unemotional you can be with your trades and with your portfolio. It's a real skill set that I don't think a lot of people have, you know, being able to stomach a relatively quick double-digit drawdown if you have conviction in the idea. Argentina is probably a good example of that. Can you maybe walk us through some of what you've talked about with Argentina?
I don't think we have time for the whole story, but I'll just say that, you know, when Javier Milei first came on the scene, I thought he was going to be the next president, and bought a few stocks in Argentina. He got elected. The stocks went up. They continued to go up. The one in particular that I have right now is GGAL, which is Grupo Galicia. It's a bank. I think it's the biggest bank in Argentina. And it traded up to $70 a share, the ADRs. And then it traded down to about 39. And I said, okay, this is overdone. So I bought some. And then it traded down to 26 ahead of the midterm elections. And I said, no way is this guy going to lose the midterm elections. You know, the quality of life has increased so much in Argentina. You know, he might have lost the local elections in Buenos Aires, but that's Buenos Aires. It's full of Peronis. I said he's not gonna lose the midterms, and it was a landslide. He won 40 to 20, 27 or 25, and GGAL was up 40-ish% yesterday. It was up another 8% today. So that's working out, and I'm holding that one for the long term.
How do you deal with that from a psychological perspective when you just enter a trade, right? And then it drops 10, 15%. Is it an individual case by case assessment, or do you have some sort of magic that just makes you not stress about that sort of thing?
I think it's partially magic. It's not that I'm some Buddhist that never gets stressed about anything. Like, I get stressed about other things in life, but I don't get stressed about money. I've never been stressed about money except for 2 times in my life. once in 2008 and once in 2017. It's the only times in my life I've ever been stressed about money. And I just, easy come, easy go. I bought it at 39 and went to 26. That's a 33% drawdown, and that happened in a couple of weeks. So then you have to ask yourself, okay, is the thesis still intact, right? Is the thesis still intact? If it is, then don't worry about it or buy more. And if it's not intact, if the thesis is broken, then just unemotionally sell the position and just move on to the next trade. We had I had a subscriber write into me, and he talked about how unemotional I was about cutting losses. And I really like it. My ego is not tied up in it. I don't feel a need to be right. I can be wrong small a bunch of times, and survive.
That, I think, is the key right there. One of the key lessons from Jared Dillian, I think, is that, like, don't size your position too big if it's going to cause you stress. You've taught me that, and I think I've heard a lot of other people over the years say that.
You can also have stress if it's going up. If you size your position too big and it goes up, that also causes you stress. Because then you're like, now what am I going to do?
Zen Buddha Trading Wisdom with Jared Dillian.
That sounds like my next
Sensei
book.
Jared. I like it. Yeah, I think it's a good idea.
Yeah.
You probably do a lot of people a lot of favors. When is the Awesome Portfolio book coming out?
Not for a little while, not till September of next year. I'm actually, when the secret of this book is I wrote it in 10 days. I wrote this book in 10 days. So it was Christmas break last year. I wrote it 7 days in a row. I did about 5,000 words a day. Then I wrote it one day in March. And then when I went to Mississippi on my writing retreat, I finished it. I wrote it for 2 more days. So the book is done in 10 days. And when I wrote it, I'm like typing, I'm like, this is absolute crap. I'm like, this is the worst thing I've ever written. So I just hit send to my editor. I'm like, you deal with it. And I figured I was going to hear back all kinds of nasty comments from him. Like he loves the book. So I'm going back and reading the edits, and I'm reading the manuscript, and I'm like, holy crap, this is really good. Like, I'm really onto something here, So I'm excited about it. I can't wait for it to come out. We just got to get some publicity.
So I had, unfortunately, she passed not too long ago, but I had a lovely neighbor who was a pretty well-known artist who she would paint really intricate, elaborate paintings that were maybe, 2 feet by 3 feet, pretty good size. And I made the mistake once of asking her, how long does it take her how long does it take for you to do one of your paintings? And her answer, I'll never forget it. She said, a lifetime. And I think that's what's going on with you. You're a lifelong writer. So when you say, I wrote this book in 10 days, that's because you've written for 30 years and you can write a book in 10 days.
Well, and it's also because I've been thinking about the Awesome Portfolio since 2018. I think about it every day. I think everybody should do this. I think this is how people should invest. I think it's a solution. So I really, really believe in what I'm doing.
Let's end with just the simple version of what is the Awesome Portfolio.
20% stocks, bonds, cash, gold, and real estate. And you rebalance annually. And it's really that simple. You can do it with 5 ETFs.
No stress. We back tested it. It outperforms a more traditional 60-40 portfolio with a lot less volatility.
It doesn't outperform the S&P 500, and that's one of the things I talk about in the book, is that you are trading away about 1 or 2% a year in gains for much, much less volatility. So it has about half the volatility of the S&P 500, and you're only giving up about 1 or 2%, about 1.5%. So, and the whole argument of the book is, for most people, that is an acceptable trade-off for happiness, right? So you're not checking it every single day. You're not glued to your phone. You're not glued to your computer screen. You're not thinking about it when you're in bed at night. You don't have to. This gets back to the Zen Buddhism thing. You just don't have to think about money ever.
And when the market does have a correction, you're not throwing up in the sink and selling selling at the exact wrong time.
In 2008, the Awesome portfolio was down 9.8%, and the S&P 500 was down 38%.
All right, Jared. Always good to see you. Thank you for this dose of Buddhist wisdom. Let's do it again soon.
All right.
Thank you for stopping by. If you haven't already, please sign up for my free weekly newsletter, where I give you my thoughts on what's happening in the economy and the markets, and a link to our latest interview. You can find a link to that newsletter in the description below. I'm Ed D'Agostino. Catch you next week.